Okay, so today is our week 14th tutorial, and I see there is no people here. I guess it is very hard for them to come on Friday nights, so I would just talk to myself and just talk about today's topic. And so let's just get started. Today we are going to talk about the linear regressions and the capital asset pricing models. In particular, I want to first talk about the capital asset pricing models, and then we go into the linear regression and the Python coding parts, because linear regression has a lot to do with the CAPM models. Okay, so first, recall from the last tutorial, we talked about the optimal complete portfolios. It argues that individual investors will choose between the risky assets and the risk-free assets. So essentially, they are trying to allocate their funds between these two assets and try to maximize their expected utilities. So we can derive this capital market line here. It is the risky assets of the market portfolios, and it is actually just the special case of capital allocation line, because we argue that now the risky asset is the market portfolio itself. So if we look at the expression here, we are essentially trying to maximize the expected utility of an investor, right? So if we take the first derivative with respect to y, then we can have this y star, and it means that in order to maximize one's utility, he should invest y stars in the risky assets. In this case, it's the market portfolios, and it should also invest y minus y 1 minus y star amount of risk-free assets. Okay, so this is a rough idea about the optimal complete portfolio. Then so now we are wanting to think about one thing: is what if an investor deviates from its optimal choice here? And we know that this could lead to a very important observation, that is, the amount of borrowing in the market should equals to the amount of lending in the markets, right? Because you cannot make money out of nowhere, and you can't make money disappear whatsoever either. Therefore, by using these observations, we can derive the following two mathematical expressions from here. And the first one is essentially just trying to find the difference of the portfolio P and the portfolio of the markets. And here P just means the slightly deviations from our optimal portfolios. And the second sentence is just the variance of the portfolio P should be roughly equals to the variance of the markets. I believe it is very intuitive, because we here we just deviate just a little. So in the long run, it will not influence our portfolio's variance significantly. So their variance should be the same. So after we derive these two expressions, then we can get the red relationship here. And here you can see that on the denominator, it is essentially just the excess returns of the stock X, and in the denominator it is just the covariance of the stock X and the markets, right? So it will hold true for every assets in the market. So for X, it has these expressions, and for Y, it has the same structures, right? You just calculate the excess returns of the Y assets, and then calculate the covariance of Y assets and the markets. then it will hold true for every asset. And of course, we have one particular asset that interested us. That is the market, the whole market portfolio as an asset, right? And it will also hold true. And we can have this last expression here, because now we know that the covariance between the market and the market is just the variance of the market itself. And after we get this X relationship, then we can define the kappa and beta as Y. And here the Y, it means the beta I equals to the covariance of the stock I and the markets divided by the market variance. So you might wonder, like, why do we need such definitions? Then if we combine X and Y, then we can have this expression here in the highlight part here, and this is essentially what we want, right? It looks like a slope, and this has something to do with the linear regression that we are going to mention later on. But here, let's just introduce some important kappa and beta. So as the definition of the kappa and beta here, if we want to calculate the market portfolio's beta, then here the Ri would be the Rm, right? Because it is the market portfolios. So, but the covariance of Rm and Rm is just the variance of the market. So the denominator will also be the variance of the market. Then therefore, we can get the market beta would be 1. The next thing is the risk-free asset. And as we know that risk-free asset is essentially just something that gives you a certain cash flow that you would definitely get without any problems, and so it will not fluctuate with the market. So that means the covariance between these risk-free assets and the markets will be 0, and therefore his beta will be 0 too. And the next one is just a simple calculation that states the kappa and beta of a particular portfolio P will be the weighted sum of the beta of all the stock in the portfolios. Okay, now we have introduced the how we derive the kappa and beta, and some statistic introductions. Then now we can have this regression here. And if you look at the highlight regression formula here, then it is very similar to the one we just derived from here, right? Here you can see that our definition is very much like the same, but the only difference is that our regression line contains an intercept and an arrow term. So that is because in order for us to get the accurate regression form, then we need to provide these two things, right? But later on we would discuss about how we can get this from using the Python programming languages. The next one is the variance of excess returns of stock I, and you just take the variance here, and then you calculate, you do some mathematical calculation here, and then you can derive that the variance of the stock I actually can be decomposed into two parts. The first part is the systematic variance, and the second part is the idiosyncratic variance. The first part, you can see it will be influenced by the market variance here, and this is why we call it systematic variance, because once the market variance varies, that is to say the market fluctuates, then the variance of that stock will also fluctuate. So it is related to the market. And the second term here, you can see it does not contain any market fluctuation or market data whatsoever, and that is why we call this a idiosyncratic variance, because the market's fluctuation cannot explain the fluctuations of this stock in this part. And next, we can derive the goodness of fit as well. And if you have attend the statistics course, then you may know this before. And this is essentially we are trying to compare the how accurate this dependent variable is. I mean the independent variable is, because here we are trying to link the excess returns of I with the market, right? So we want to know how much of the variance is from the systematic variance rather than the idiosyncratic variance. And the formula here, it is very easy. You just get it from here, right? And that is what we call the goodness of fit. So the next one is just the covariance of the stock I and stock J is defined as such. So we quickly go through what is the KPN and how we derive it, and then we introduce some important KPN beta, and lastly we introduce some econometric formula here. And the next thing I want to talk about is the graphical representation of KPN, which is called the security market line. And in particular, these two graphs would be very confusing in the same time if you are a beginner, because the security market line is just, as I said before, the graphical representation of KPN, right? So the KPN essentially is just what we have here. So so we are trying to measure for every unit of beta I, what would it impact the expected returns of the particular stock, right? So the horizontal line would be the beta. However, in the capital allocation line or the capital market line we introduced last time, then the horizontal line should be the variance of the stock, and the slope would also be the Sharpe ratio, right? Because this line is just not about markets, and this is completely different story. Okay, so next we have this security market line. We can have some visualization observation here. For example, if we have a beta of 1, then we should expect that this portfolio's expected return should be the market return, right? Because 1 is the market's beta, right? Market KPN beta. But if we choose beta I instead, let's say beta I is just stock I's KPN beta, then we have another expected return of stock I here. But however, we are interested in how accurate is this KPN model, right? So if, let's say, today we have some, let's say 1 year's data, and then we calculated its average return, here denoted by the RI bar, and we found out that this RI bar is actually higher than the expected return of RI that we get from the security market line. Then what does it mean? Then it means that the RI bar is higher than the expected return of RI, and that means the asset I is underpriced. Also, we call that it has a positive alpha, and that means that currently the expected the current price is too low, right? Because the KPN beta actually predicts the these stocks I's return should be lower than it actually is. So for the same story, if here we have beta j, then here the rj bar is lower than the expected return of rj, then it means the asset j is overpriced, and in the same time it has negative alpha, and also its current price is too high for the market now. Okay, so after all of these things, I believe you can grasp some very intuitive thinking about the relationship of the linear regression and the capping model. Then here I just get the slides from Professor Douglas, and here it states some difference between a capping and a single vector model. And in particular, the capping model is just a theoretical methods, and however, the single vector model or the linear regressions is about the true data, and we will have the realized returns. And in the same time, the theory predicts the alpha to be 0. However, in the single vector model, there is no such restrictions, and that is why on here I say that we need to put a alpha I here compared to this original theoretical capping model. Okay, so now the last one is just talk about the empirical performance of capping, and here you can see if the capping is correct, then the expected return and the beta should lie along the security market line, right? Just like what I draw here, the blue line is the security market line. And but empirically, the SML is just too flat. Okay, so this is the true data we used here, and that also links to what Professor told on the class. He said that the lower beta actually implies actually can get you more expected return using the historical data. So it is quite different from what the theoretical point of view, but that is I think that is true for like every field of knowledge, right? The theory would always be different from the actual world. Okay, so perhaps now we can go into the coding part and to test if the capping model worked with our data or not. Okay, so here the first thing we need to do is to get the data, and this part is pretty much the same throughout this semester, right? We are using the Yahoo Finance package to download the data we want. And let's say today I want to get the Google stock, and I want to use this GSPC index, and this stands for the I think it stands for S&P 500, right? I will just quickly take a look. GSPC. Yeah, so GSPC is just the S&P 500 stock code. And let's say we want to get the data from January 2021 to the last day of 2021. And we just download the data here. And after we download the data, we have this data frame here. And we can take a look at his columns. Here you can see there is a lot of things here. For example, there's an open price, high price, low price, or volume. But for the calculations of capping, we only need the adjusting cost price, right? So we'll just use the slide functions features in of the pandas, and just slide. We only get the adjust close column we want, and we will also drop the null value, drop the data that we don't have. Okay, so we can take a look at this data frame, and you can see here we have the Google's everyday price and the S&P 500 index every day here. But we know this theory is about the return of the stock, right? So here we want to convert the historical price to historical return, and we'll use a very handy and very familiar method, that is the percentage change method here. And after we do that, we can get the data of everyday returns. But we also want to drop an A again, because we don't have the first row of data, because for the first day we don't have the last day's information, right? So we will have an A value on the first row, so we need to drop that. Okay, so after we do that, we have our DF return data frame. And the next thing, perhaps we can get a nice visualizations of it. And if you want to draw the points of two different, let's say, assets, one is Google and the other is the S&P 500 index, then we should use the scatter plot, right? And here scatter plot is very handy. You just specify the X and Y, which is just the data you want to show on this graph. And we'll use again the matplotlib, this package, to draw. Okay, so now we have the historical data and we get a very nice visualizations of it. It looks like that these Google stocks returns should be very closely related to the returns of the S&P index, but we'll take a look after, right? So now we can do our linear regression, and in Python or in R there is a very there are a lot of ways to do the linear regression, but here we want to use the state models API. You can just install it by just typing in pip install or something to get the state models package here, and we'll use the OLS method in it, and the dependent variable y should be our stock return, right? Because that is what we said before, and here we also need to add a constant to the model, that is the alpha I here. We need to add that because in the theoretical campaign there's no alpha in the formula here. Okay, so after we add constant, then we can just use the fit method and just print our result summary here. And here the most important information is here, right? So this const means the constant, and that is just the intercept of the of these linear regressions, and GSPC is just the independent variable. And here you can see that the p-value of the index is below around 0, right? And it is smaller than the let's say the 5% significant level. So the result seems quite good. That it means that the return of the S&P 500 is a significant factor when it comes to predicting the returns of the Google stock here. And now we have this number here, but let's try to visualize it to like other guys to let them know how good our fit is. So perhaps the first thing, we can take a look at the results parameters here, and it is just to let us retrieve the number here, because we need this number to in order for us to draw the line, right? And the last step is to have the graphical representations, and here we have the y fit. That is we want to plug in this line with what we get from our linear regressions, and in particular this is just the intercept, right? The parameters of the first elements of the parameters. So if we look at the type of this thing here, then we can say that it is a series, right? So to get a data from a series, then you just pretty much use this curly bracket and then specify what data you want. For example, I want the first data, then it will get me the constant here. The second data is of course just the 1.28 here. So we put it in the intercept and the y, the x here, and so the x-axis we want to get is just the data range of x, right? So what is x? X is essentially just the return of the index, right? So the x should not exceed the minimum of this series and the maximum of this series. And we want to also plot again the scatter plot of xy, which is just the same as here. And we want to put these two graphs in the same graph. So you just write them all in one cell, and you can just draw it in the same graph. So here you can see that we pretty much get kind of a nice fit, but of course there would always be some outliers, and it seems like in our data set we don't see the empirical things, empirical results, that is the actual SML is flatter than the theoretical CAPM. We seems like there's no such thing here, but of course it might due to the fact that our data set is only covers 1 year, and the stock we use is just one stock, and so on and so forth. Because actually the CAPM model fails because it is not the case when it comes to the real world tradings. Okay, so it pretty much is what I want to talk today. So we talk about the derivation. We talk about how to get the capital asset pricing model from what we learned last week, and then we introduce some graphical representations, and we make some comparison of these CAPM and I mean the security market line and the capital allocation line. And the next thing, we try to use the real world data to test this series and let us to better know better understanding of CAPM. So that is the end of tutorials, and I hope you have some findings here. Thank you very much.